Good morning. These are the things that matter most before Europe opens. Hormuz is still keeping oil risk alive. AI infrastructure demand is strong, but more selective. Yen pressure is changing the exporter map, and European banks are facing a quieter rates and credit test. The central question is simple. Can Europe treat the AI spending cycle as support if energy, currency, and financing costs keep testing margins? Start with Hormuz and oil. CNBC reported that Iran disputed U.S. claims about the Strait of Hormuz, while traffic sank toward three-month lows. The same source had already reported U.S. crude above $83 as Iran linked reopening to conditions. Brent in the Yahoo snapshot is still near $88. For Europe, that is not just an oil headline. The cleaner side is integrated energy and energy security exposure. Shell, Total Energies, and BP. Pressure sits with fuel-sensitive airlines and cost-sensitive industrials, especially Ryanair, IAG, Lufthansa, and chemical producers where input costs can move faster than pricing power. For private investors, the useful filter is who pays for the oil risk. If crude stays high, does Europe reward energy cash flow, or does it treat oil as a tax on the rest of the market? Second, AI demand is real, but the evidence bar keeps rising. CNBC reported that CoreWeave jumped after revenue doubled on accelerating AI infrastructure demand. MarketWatch reported strong AI signals from Supermicro and Lumentum, and Cisco described record results from an AI supercycle even as its stock pulled back. CNBC also reported that Cerebras fell after its second post-IPO earnings report. That matters for Europe because AI is becoming a proof chain, not a slogan. The cleaner side is where demand can become tools, chips, power systems, software, and network orders. ASML, Infineon, SAP, Schneider Electric, Siemens, and Nokia. Pressure sits with companies that carry the AI label but cannot show conversion, margins, or capital discipline. In plain English, the takeaway for private investors is this. AI enthusiasm is not enough today. The market wants proof that spending becomes revenue without destroying balance sheets. Third, the exporter map is shifting. CNBC reported that the historic U.S.-Japan intervention failed to halt the yen slide, while another CNBC item said electric vehicles dominate China's car market. Yahoo's Europe watchlist feed also carried BMW supply chain and ASML demand read-throughs, while Shell output headlines kept energy in focus. For Europe, yen weakness and China competition are a pricing power test. The cleaner side is companies with strong brands, local production discipline, or defensible technology. Pressure sits with Volkswagen, BMW, Mercedes-Benz, Stellantis, LVMH, and Kering if currency and local competition squeeze margins at the same time. For private investors, do not reduce this to one China basket. The useful question is which companies can defend price and mix when currency, local competition, and consumer demand all move together. The underappreciated story is banks and credit. Europe does not only need growth headlines. It needs funding conditions that do not tighten underneath them. Yahoo snapshots show major European indices only slightly lower, the VIX still around the mid-teens, and U.S. 10-year yields near 4.7%. That is not panic, but it is not a free money backdrop either. The cleaner side is disciplined banks and insurers that can manage net interest margins and credit risk. BNP Paribas, Santander, UniCredit, Deutsche Bank, and Allianz. Pressure sits with highly leveraged property, weaker cyclicals, and companies that need cheap refinancing to make their equity story work. For private investors, the hidden mechanism is financing quality. A theme can look strong at the top line, while credit costs decide who actually keeps the gains. Here is the stock-led watch list for the European session. First, Shell, Total Energies, and BP. Do they confirm oil as cash flow support, or does crude become a market-wide margin tax? Second, ASML, Infineon, and Schneider Electric. Do they confirm that AI infrastructure spending is reaching Europe's tool, chip, and power layer? Third, Volkswagen, BMW, and Mercedes-Benz. Do they show pricing power against yen weakness and China electric vehicle pressure? Fourth, BNP Paribas, Santander, and UniCredit. Do banks behave like stable rate beneficiaries, or like early warning signals for credit stress? Market bias, selective and proof-driven. Europe can trade constructively if AI infrastructure, energy cash flow, and banks all confirm. But the mistake to avoid is treating every big theme as immediately investable. Tomorrow's watch, whether oil stays a cash flow story whether AI orders broaden beyond the obvious names, and whether exporters can defend margins in China and currency-sensitive markets. That is the Europe Morning Market Brief. We will be back tomorrow with everything that matters. Research context only. This briefing is not investment advice.